Hello, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues my explanation and advice surrounding closed-end funds and that type of investment strategy. If you want the full methodology for our 12 steps to financial freedom, then go to Facebook and check out my group there called Adaptive Perspective, Navigate Your Finances, where I give you the whole framework for free. And I keep looking off because our little cat has been not into everything so far, but as soon as I start doing something, he likes to start playing around. So this is an unedited video. Who knows what else you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, which you could argue is the same thing, but there's a specific degree set and certification that goes with being a financial advisor, and I do not have that. I prefer strategist, where I can look at things logically and give you a best scenario based on facts. And then I don't speak like the herd, which I rather enjoy, to be honest. I walk in limited company, and sometimes I walk alone. So my daughter and I were in the car the other day and talking about what we have recently decided to do regarding our individual brokerage account. And no, we're not selling it in the sense that we're getting rid of all of it. We made a calculated choice to open up a Roth account because it would impact our taxes not this year, but it would impact our taxes 24, 25, 26, 30 years down the road. And it's hard to sometimes look that far in advance, right? Like, who knows how the world will be 30 years from now, 25, who knows how the world will be next year. But 30 years from now, you can pretty much bet you and I will still be paying taxes. So would you rather pay more taxes on what you're making, or would you rather pay less? And pretty much everybody would like to pay less. Some people would like you to pay more, but everybody would like to pay less. So our current goings on and self-investment into the market is not costing us a lot out of pocket in order to invest, because you're paying those in the sense of, I mean, you're contributing to your brokerage account, whatever you buy and sell, right? If you're selling for a profit, you're paying capital gains on those. If you're reaping dividends, which is what we're doing, you're paying dividends on the gains, or you're paying gains on the dividends. Um, those are great, but would you rather pay taxes on that? Would you rather pay the capital gains taxes on those or not? And the taxes we're paying on that is not, I mean, we're not break even, like we're paying taxes on the gains, but at the same time, we'd honestly rather not. So if we can do the same thing inside a Roth, why wouldn't we do the same thing inside a Roth? So we sold some things, and it's kind of weird. We're still investing on a Webull, so we sell those stocks and transfer the money to a bank account, just to wait for a little bit to transfer them back into a Webull account, except now it's a Webull Roth IRA instead of a Webull individual brokerage account. Same platform, pretty much the same format, it's just an overall different account. So we're talking about this, and she said, and she asked kind of, so we use closed-end funds because of the dividends. It was like, well, that's part of it. It's the discount. Now, if you look at the talk show, pick your talk show syndicate. It's generally by Apple, by Amazon, by Google, right. And for the most part, they don't pay dividends. Apple pays a 0.5% dividend. And if inflation's at 2%, then you're losing 1.5% on the devaluation of your money. Like you're gaining a 0.5% dividend. Inflation is at 2%. You're actually losing money every year just on the devaluation of currency. But that's if you believe the Fed. I typically think inflation sits around 4%. So when we have rampant inflation like now, which is still less than it was a year ago, and the Fed just continues to manipulate. So when inflation sits at 4%, you're losing 3.5% just by owning Apple. Now it could go up 10% in 5 years, but you're still losing money because the devaluation of currency. So if you want to own Apple, but you don't want to lose money by owning Apple, then you could own Apple in a closed-end fund. I'm not saying that's the only reason to buy. That's not my point. But we could own a closed-end fund that owns Apple and Amazon and Google and all this other stuff. It's structured like a mutual fund, except you're not paying full price. You're paying a discount. Now you can pay full price if you really want, but why would you want to pay full price? So if you can buy the same companies for a discount, like instead of paying whatever Apple is now, Microsoft is now the biggest company, but when Apple was the biggest company, however much it was a share, would you rather pay, which I can look up right now. Um, I normally go to the online investor if I want to look at general funds and the overall value of those funds. Let's see if that site will pull up. We look at Apple. Oh, goodness. Things not planned. So if we look at Apple, uh, closed the day trading on Friday at 176.55, with the current yield still being pretty much 0.5%. So instead of paying $175 for Apple, if you could buy it through a closed-end fund and get it for, gosh, $10, and at the same time get Apple and Google and Amazon, right? So you're buying it for a lot less. You're getting it at a discount, so you're not even paying full price, and not paying full price in the sense that the closed-end fund is 10 and Apple is 175. That's not it. The overall value on the closed-end fund you can get at a discount. So if you're going to buy it for 10 at a discount, and they're going to give you 9% a month for owning it for that dividend, and you're not going to have to individually buy all of these other funds, why wouldn't you get a much better deal? And that's kind of closed-end funds in a nutshell. So if why closed-end fund? Well, so the discounts, right? Do you want to pay full price, or do you want to buy it at a discount? Do you want a cheaper overall buy-in? $10 at a discount sounds a lot much better than $175 a share for just Apple. You get great dividends. Current average is 8.4. I'm looking at my cat, try to navigate the table, and he's not doing a great job. Uh, let's see, great dividends. So current average is 8.4. I want to say our portfolio average is a lot higher, but maybe around 10, but we've kind of sold some things recently, but it still sits around 10. You get the overall appreciation of the individual funds you own. Oh, goodness. Look, he climbed the chair behind me. Ah, cute cat who turns into a menace. He's messing with a plastic bag. What catnip does to cats, plastic bags do to him. Ah, so you get the overall growth of individual funds as well as the added bonus of having a great dividend. And then you get inbuilt diversity within the fund. It's like a mutual fund. So depending on how the fund is invested, uh, you could have all energy infrastructure. You can have all corporate bonds. You can have all real estate. You can have all of one specific thing, but then diversified through all these all these different companies within that individual sector, or you can have portfolios that are like portfolios in a can, where they're fairly evenly split between three, four, five, six different things, and you get all of this added inbuilt diversity. Cat. Now, diversity for the sake of diversity, I'm not for that. I'm in for targeted strategy for a reason. So just to diversify because you want to diversify, that's your strategy, that's you, that's not me. That gets into what I've said over and over. It's what it's how Bilbo describes himself, having owned the ring for all this time, is that he's like butter scraped over way too much bread. If you have this giant slab of butter, right, and this measly, or so, if you have this giant slab of bread and this measly amount of butter, it's like trying to make garlic toast, and you're only going to make garlic toast out of that much of it. And that's kind of diversity. Diversifying for the sake of diversifying is not diversity. Yeah, a Lord of the Rings analogy. My daughter likes it. Uh, so with closed-end fund, like any other funds, like any other part of the market, where would you invest? So it comes down to your overall strategy. I know our strategy. Do you know yours? Do you buy low and sell high? Do you dollar cost average your funds? Do you invest for the short term just to flip that money and then turn around and do something else? Are you going to build something that you can manage, but at the same time you can build it and kind of like set it and forget it and add to it? Not so much forget it, but set it up and let it run and then add to it. Are you like, what's the overall point to your investing, right? We want to supplement or live off dividends. Are you going to take the traditional method, which I think is a flawed way of doing the 4% rule, but are you going to try to grow your overall portfolio so you can try to do the 4% rule, which is really like an 8% rule? Um, are you going to follow the herd or not follow the herd? So in our strategy, we're going to use the strategy unless you have a really good reason for not doing that, which I'll get to. It's monthly dividends. If you find a great quarterly payer, if you find a great quarterly discount, that's fine, but it's really monthly dividends. And then specific sections of the market, uh, it's whatever you, so it's using our system, which I'll get to if you haven't seen it, but it's using the system looking for really amazing discounts, right? So you want to get things cheap. You don't want to pay too much for them, right? You don't want to pay overvalue for them, even though they're already discounted. So this it's not an end all be all thing, but I do. It's really the only thing I look at CNN is their fear and greed index, and you get a general feel of the market and how the market's doing. So, a month ago, we're borderline extreme greed. Last week, we're still in greed. And at end of market on Friday, when the market at large finally realized that the Fed isn't going to be cutting rates like everybody predicted, and like I've been saying, well, I have not been saying the same thing as all these talk show guys. That's not my point. So and I'll get to this, but instead of me muddying and confusing this, the current greed index is almost in fear. And that's really honestly like a great time to buy. So the same people who have been saying the Fed's going to cut rates 6 times this year are now saying maybe the Fed's not going to cut rates at all. My hope is that they cut rates. I mean, I was hoping now in the first quarter, but after having been in the first quarter and hearing the data, we would be lucky if it happened over the summer. I would still hope they cut rates at the start of the next presidential cycle because they want to keep their jobs. So the Fed engineers the economy. When I mean the Fed caused this problem. How often do you hire the same people that caused your problem? Like if you wanted to redo your bathroom and you're your own subcontractor, you're hiring all these different people to do all the work. So you hire a plumber or you hire a remodel company to break out all the walls, tear it all down, and they do all that fine. And then they come back in and they mislay your floor. The walls are all crooked. The tile in your shower, it leaks. Would you hire the same company to come back in and fix it? No. Like I did my research and y'all screwed me over. I'm going to pick somebody else. But that's not the case with the Fed. The Fed causes problems that they then walk in and go, oh my gosh, it happened. Now we have to fix it. And they're fixing the problem they intentionally caused. The Fed printed $4 trillion in 4 to 6 months, 40% of all currency in existence. They printed in less than a year and then had the gall to go on TV and say, oh my gosh, we had no idea this would happen. Bullshit. Like bullshit. You printed a ton of money. You devalued the money by printing so much of it and said, oh my gosh, inflation is so high. So the Fed was, if you look at the terms, they were doing quantitative easing, low rates, they're printing a ton of money, quantitative easing. And then all of a sudden, oh my gosh, inflation, not so much that rates are crazy, it's that there's so much money in the market, the value of money itself decreases. So it takes more, it's devalued. So it's not worth as much. So it takes a lot more to buy the same amount. So they go, oh my gosh, inflation's high. So they go to QT, quantitative tightening. They raise rates, trying to pull money out of the market. And they raised rates faster than they've ever raised them before. It takes 3 to 6 months to see how well the rate hikes are doing, and yet every single month we're raising rates. So we jack the rates, market goes crazy. And about 4 to 6 months ago, while they're talking on both sides of their mouth, while they're still saying, oh yeah, we're raising rates or we're trying to keep rates steady, all that jazz, they started printing money again. Now they didn't go, hey, we're printing money again. They said, oh no, inflation this, inflation that, and on the side they started printing money. So what did we see in January? Inflation went up a little bit. That's weird. Didn't go up enough though. Didn't go up a lot. Went up like 0.4. But with consistent rates not going up and everything holding steady, it's kind of weird all of a sudden that inflation went up. And they do the same thing. And then it goes up a little more in February. Then it goes up a little more in March. And now the same people who are going, oh my gosh, they're going to cut rates 6 times this year, which would have been amazing, right? Are now going, maybe they're not going to cut rates at all this year. And the Fed, who's now going to look at data for this month, is going, well, we've had 3 months of increases. I guess inflation's just proving stickier than we thought. So connect the dots. They were doing what they should have been doing all along, right? Now, if we could pick anybody else to solve the problem, we would, but we can't because it's just them. So they manage inflation and they manage to keep it steady. And it's holding steady. And it's holding steady. And the market at large actually decreased overall rates. The rental rates dropped, right? The national average hasn't changed, but the average mortgage loan dropped about 0.5%. That's good. And the Fed quietly starts printing money. And then right after Christmas, inflation starts to go up. That's weird. It went up again. It went up again. So 3 months of small increases. Now the debate is, will they even decrease it? Well, it's not so much will they decrease it, is will they raise it? And Jamie Dimon, the CEO of of JP Morgan recently said we're in all of our scenarios for the year, we're preparing for rates anywhere between 3 and 8%, if not higher. That's really scary, to be honest. Uh, doesn't scare me, but as a country, that's scary because if they're preparing for rates higher than current inflation, right? It's like what, 6% national average, 6.5% national average on interest rates. But if they're preparing for rates that are 8%, meaning the Fed would raise rates this year more than once or higher, higher for longer, that's concerning because that tells me what the Fed is quietly saying. Inflation is steady, but we're increasing it because we're printing money. So the overall rate of inflation is increasing, which means the overall interest rate is going to have to increase in order to curb the inflation the Fed is causing again. So I would imagine they try to cut rates at the beginning of the election cycle because they want to keep their jobs and be like, oh my gosh, look at the economy. It's doing better. Just to have the election turn out however it's going to turn out. And as soon as that comes around the next time, it's at the beginning of the next presidential term, it'll be a raise in interest rates. So kind of interesting how it's all going. Concerning how it's all going, since you have the same people tasked with fixing it. Okay, so in that kind of market, where should we look for the present, but also the long term? So you have the overall bond market, senior loans, adjustable rate loans, that kind of fits in there. You look at real estate. If you can make money at 6.5%, 6% in real estate, you can make money at 3% in real estate. Look at the AI boom, but not outright AI. Look at the data management, the data and the data management side. So the data transfer companies. So instead of buying, say, Verizon itself, you would buy the cell phone towers and the people who manage all the data. Then you look at overall energy infrastructure. So we always need oil, whether you like it or not. All the technology stems from oil. So we still need oil, but then liquid natural gas, energy transfer, utilities, all of that stuff, we need that. So then we're using those overall targets to then see what we can find in discount land in closed-end fund world. And then additionally, as we sift through those individual funds, we're looking at convertibles who can shift between bonds and stock. We're looking at preferreds, the dividends that get paid first as compared to the common shares. We look at the areas where the broader market is ignoring them. The talk show guys push specific funds, wanting everybody to buy into those funds for any number of reasons. They own the funds, they're part of people who own the funds. It's great for them. But the places that they're dogging, like real estate, somewhat bond, Bloomberg finally hopped on the bond bull, but between the meddling Fed and just the market in general, the bond world is still up and down depending on what bond fund you find. So real estate, bonds, it's kind of late to get into the utility and the oil market, but if we can find deals there, that's where we want to be. So let me pull up our list, which has changed considerably from last week. And we'll get into this more. Since I already prepped for this video a little bit, which is not what I did last week either. Let me delete this page so you get to see the full thing. So this is the closed-end fund master, and it's very different than it was last week because we sold some things. So the strategy is this. We're looking at the individual data compared to the individual data for that fund, not in comparison with all the other funds. So we're looking for discounts that are currently greater than either double or greater than double the discount average for that one fund for the overall history of the fund. And then for the last 5 years, we want a discount that's greater than the last 5 years. And for the funds that are, say, 3 years, 2 years old, 4 years old, we want a discount that's above average of what it's been so far. And for the one or two funds that are brand new, I mean, if the fund started out with 16% off, 6 months later, if it's 12% off, it's hard to, like, we want a decreasing average. So it's going to be hard for that average to decrease lower than the existing amount. So there's a little more leeway in a really young fund. So gray doesn't meet the metric. Purple is recommended by somebody I read and trust. Green, we track for any number of reasons, and blue, we own. So if we rank them by discount, which last week this was blue because we owned it last week, as was this one. We sold it as so we sold it going into kind of essentially doing two funds. So we rank it by discount, and then we inverse rank it by target. And everything with a triple asterisk is on the consideration list for the week. And then we're going to weed that down from there. Let's see, insert left. So before I get there, so it used to just be these 5 tabs, but I've added 3 more. Have not bought or sold anything yet on the Roth. We're still transferring money over. These are the initial dividends I've considered. This is kind of the overall hit list. This is what I know I would like to get. This is the hit list of things for the future. I want to set up a fund. So where the brokerage fund, it's like I can buy, sell, make dividends, and then take those profits and then transfer them into the Roth. And then on the Roth, I want a fund where it just grows. I don't really have to worry about selling something unless something catastrophic happens, something I can't predict, right? But if I have to sell a fund, then I have to sell a fund. I want to set up a portfolio that's structured well, yes. It's not diversity for diversity's sake. It's just a well-built portfolio that lasts, where I can just set it up and let it grow. But getting into this week. So that's odd. What happened here? What in the world happened here? Did I not select the whole thing? I did. Same thing. This, insert, shift right. What in the world? Every week it's the same setup, doesn't change. And yet when I copy these over, things tend to change. It's the weirdest thing in the world. Okay. Interesting. All right. Um, everything's targeted, and that all of these are significant. That shouldn't be on the list. It's the interesting things you encounter when you do things live. So all of these are significant, or I guess all of these are significant. We've been targeting things that are monthly payers. So we can't, I mean, you've got startup money of what we own, startup money, um, overall energy infrastructure, and healthcare that we want to sell. So we're going to delete these. That's my cat you hear in the background. So now we have all monthly payers. Now we're going to target overall funds. The one that's going to remain is this one. What in the world happened here? Like, what in the world happened? This one's going to stay because it's the greatest discount. So we'd be foolish to ignore it. And I keep hearing, I hear mixed data. The portfolio is doing better than people thought. Fears are, I guess, oversold, I guess you could say, uh, versus the guy who manages this also manages a real estate group. So he bought into the other company he manages. It's in the midst of they went from mostly bonds to mostly real estate. They had a dividend cut that it's kind of mixed results. Um, but me personally, I think the yield will come back, and the guy who runs the company does really well. So it stays on our list. Um, our goal has been everything over 9, unless you have a good reason for breaking it, and I've got a reason for breaking it. So if we go top yield, right? Everything over 9 except that one, but it stays on there for a reason. So you think of bonds or floating rate loans. So bonds, data management, real estate, um, bonds, data, real estate, overall energy infrastructure. That's what we're doing through on this list, or I guess going through on this list. So you have corporate loans, bonds, and their own closed-end fund portfolio. You've got a mix. It's not exactly a portfolio in can, but it's got a decent mix of funds. But they also do data management. I can argue for this company. I mean, we just owned this company. We just sold this company. I can argue for this company, but the overall concern is their reverse stair step and overall dividend cuts. So long term, they should do well once the starts cutting rates, right? But at the same time, their dividend track record is like this. It's kind of hard to buy into it again. FCO is still recommended by somebody else, and I like how the company's set up. It's brand new. Uh, Current discount is less than the overall discount, but it's only been around a year, so that's going to happen anyway. Excuse me. Um, it's a long-standing real estate firm, um, and it doesn't look like that big of a discount, but compared to where it is historically, it actually is a pretty big discount. Technology fund, these two generally make the list. They make this list. I generally don't keep them because I'm not a huge consumer person. Maybe that'll change. But for me, the consumer market is just too volatile. It's everything's cyclical, but you could argue that everything else is cyclical. So oil and real estate are cyclical, but they're their own divisions in the market, and the like cars, grills, food services, real estate, oil are in theory all consumer-based products. Technology like the laptop, the phone, is the fridge, all consumer-based products based on their cyclical nature. And I think just the overall consumer market is way too volatile. I don't like it. Maybe that'll change. BRW, so uh, the billionaire behind Sava is taking over companies and encouraging what I read. He's taking over companies and encouraging funds to perform better. So they took over this fund, they've taken over this fund. Uh, they're structured a little bit differently. This one is corporate, this one is government, but it's really primarily bonds. um, or I guess loans. So you have corporate loans, bonds, assets, and closed-end funds. And then you have this one, which is government bonds and some other stuff. Um, it just depends on your individual strategy. Say government bonds are lower risk, they're going to pay. Corporate bonds would be government bonds, less risk, um, less risk, assured payout, and corporate bonds are more risk, higher payout. And then HFRO is currently now real estate. It was bonds, now it's real estate. So you have corporate loans and bonds, a mix of things plus data management, all American corporate bonds, real estate, technology, and then more bonds. So it's uh, what's the best pick now? This is about $2 higher than where we bought it. So it wouldn't make this list if we're looking at the overall brokerage account, but I actually want to look for what we would buy and invest into the Roth, uh, which would be, we haven't bought anything yet, but this is the initial planning of that. NBXG is on the list, but technology is still inside its own bubble. It's running rampant, and you could wager that it's going to continue to scale up. If you invest in the AI company and end up like semiconductor, the main broader uh, components to that, they will be in demand. If you invest into the companies that need it, right? Uh, it's finding that sweet spot between investing into the companies that need it versus investing into the individual parts to investing in the overall data management side. And if you can find a company that does all of it, I think that's a much better sweet spot than just buying into Taiwan Semiconductor or buying into Samsung. And this company seems to do well in how they do things. That being said, it's like $2 higher than where we bought it, almost. So it's not going to make this list because it's not a great deal. Now maybe it goes $2 higher before that bubble pops and then it degreases. But I want technology to have that hiccup in the market, and I would buy the hiccup. Or as we are on that fear and greed index, right? We were here 2 months ago. Now we're creeping back down to here because the market at large realized the Fed doesn't have as much control over inflation as they thought because maybe they don't realize the Fed is printing money and causing that inflation to go back up. But that hopeful rate cut is not so hopeful anymore. So you got more fear into the market, more hesitation, more pullback. And if this meter drops more, that means the overall value of stocks will drop more. And that's a great time to buy technology, bonds, anything. So if we were buying tomorrow, and we're not buying tomorrow, we've got money to settle inside our um, Roth and some other decisions to make. But if we were buying tomorrow, what would we buy tomorrow? Well, honestly, I would buy, if we weed through this, I would buy between those three companies, which are the top three companies right here. And it kind of comes down to what you have to invest. That's what we have in that's what we're kind of waiting to settle. You could put money in for 2023 up until 4/15 tax day. So we maxed out our account for last year. This year you can put in a max of 7 grand. I don't know if we'll max it out for this year, but in the transfer over, that's what we'll transfer over. And then it becomes, how do we want to do that? Do we want a dollar cost average over a couple months? or do we just want to buy everything and let it sit? And with the market going like this, it's almost like a it's almost like really timing the market is impossible, right? But we kind of wait and see how the week goes. Corporate earnings, I think, was started last week. It'll get into on this week. The Fed will meet at the end of the month, and we'll see if rates hold steady or they go up. If they go up, then the overall fear in the market will increase, and we'll end up even more over here. So I kind of think we see how the month plays out on rates and the Fed, and then we go from there. But we always, evaluate every week, and then also go from there as well. But if we were investing tomorrow, my cat wants to play. We were investing tomorrow, what would we buy? We would buy those top three companies. And that's actually not BRW, but we would buy probably 50 shares just to spread it. Because what we did own, we owned 200. We didn't own RFI. We didn't, of this list, we did not own that company. Cat wants to play. He's scratching the computer. We owned all of these, and we owned maybe 250 in HFRO, but then 200 shares otherwise. And where we would put money next week if we were buying, really, I like 50. I like sets of 50. We would put equal into all of them. But we're not. I'll be honest, we're not buying tomorrow. Partly because we're waiting for that to settle. Also, partly because there's a lot more fear in the market currently. And just based on a week, last week, at the end of the week, we were here. And the market at large went, oh my gosh, the Fed's not going to cut rates anytime soon. So we'll see how the rest of the earnings cycle goes. And we'll also see how the Fed meets at the end of the month. But if the Fed keeps rates the same in the midst of rising inflation that they're causing again, that'll be concerning in and of itself. If they raise rates, this meter will continue to fall. If they decrease rates, which I don't see how they can decrease rates when they're causing inflation to rise. If they decrease rates, the talk show guys will be like, oh my gosh, now's the time to buy. But I don't know if that'll happen. But that's just me. So that's what I got for the week. I have 3 picks for the week if we were buying, but at the same time, we're not buying. And what are we buying? We would be buying real estate bonds. I mean, they went from bonds to real estate, and it's like real estate everything. It's real estate outright and real estate bonds. We'd be buying corporate bonds, and we'd be buying a mix of things: real estate, energy, bonds, and data management. And the data management side of the AI boom, I think, is often forgotten. We look at all of the improvements in technology overall. We rarely talk about the ability to house all of the data and to manage all of the data and to safe keep all of the data for everybody else. So it really is. It's not talked about, and we should probably be talking about that a lot more than how technology itself is expanding. So that's what I got. If you like my content, consider subscribing to my channel. Hit the like button. It really does help get videos out to other people. And then head over to Facebook and check out my group there called Navigate Your Finances, where I talk about the entire system for the 12 steps. So as you face the week, as you face the rest of your life, you are the captain of your ship. You captain your ship, and it will go where you want it to. If you have no idea where you want to go, that's its own problem. And that's what I teach on Facebook. Oh my goodness, my cat is needy. He's currently grabbing the screen. And he's like, I'm the center of attention, not your video. But yeah, it's take control of your life. If you're going to let your boat just drift listlessly wherever the wind blows, it's not really helping you get to where those dreams exist and where you want to go. So you are the captain of your ship. Captain that ship and tell it where to go. And if you don't know where to go, then come find me on Facebook and let's talk about where your dreams exist and how to make those things happen. So I hope you have a great week, and I will see y'all on another video. Bye-bye.